Hi friends, now in this session we will discuss depreciation expense from CFA Level 1. Reading is financial statement analysis, subject is financial statement analysis, and reading is reading number 3, income statement analysis. Now in this reading, depreciation expense is very important concept, important from exam standpoint and as well as slightly confusing for students who are very new to this particular area, which is accounting. Now here we will start a discussion from very basic. We will first understand what is the requirement of depreciation expense, what are the accounting principles working behind the depreciation expense as a concept. Then we will discuss what are the methods available in depreciation. So straight line method, declining balance method, or double decline balance method. So these are the methods available. And with this we will also discuss the concepts which are amortization and depletion, which are related to depreciation, but the wordings are different. And I will also explain like what is the reason behind giving some expenses the name as a depreciation expense. Some are called as amortization, some are called as depletion. And with this we will also discuss how amortization works differently for goodwill as well as for the intangible asset which have a limited life, right? So let's start our discussion first. First thing is the requirement. What is the requirement of depreciation expense? Now let's assume a scenario. I'm starting a business and I'm expecting, like, I'm able to project the revenues for next 3 years. So this is the end of first year, second year, and third year. So this is your timeline. And here the expected revenue is say $1,000, $1,000, and $1,000. Now to generate this revenue, I'll need one laptop. Okay, so I need to use this laptop to generate this specific revenue. Please note this. And this laptop costs rupees 1,500. Now, first, this laptop should be considered as asset. Why asset? Because this laptop will give me economic benefit. This should be called as asset. Why? Because this will give me economic benefit for more than 1 year, one financial year. So using the same laptop, I'll generate revenue for first year, second year, and third year. So ideally we should call this as an asset, but for now I will just treat it as an expense, and then I will explain you how things work differently when we change our assumptions. So for now we will treat it as expense. And if we treat this particular expense, cost of purchasing laptop, as expense, then this is our revenue side, plus side, and this is our cost side. In profit, if I charge complete expense, because I'm incurring expense in first year itself, if I charge this expense in the first year, so what is my net profit or loss? So in first year, I will generate loss of $500. In the next year, end of second year, I will generate profit of $1,000. And then at the end of third year, again, I will generate profit of $1,000. So 500 loss in first year, 1,000 in second year profit, and then again profit in third year. Now here, there is one particular problem in this particular setup. We charged one particular expense in single year, but this particular expense is going to provide me value or economic benefit for multiple years. So this, if you do this, like I did here, I charge complete expense in single year. This is violation of matching principle. Matching principle. So what is matching principle in accounting? So matching principle says that you should match your expenses with the revenues. So if you are spending some money for generating revenue for say multiple periods, then your expense should be allocated in those multiple periods. Here, these $1,500 are going to generate revenue for me in multiple periods. So year 1, 2, and 3. So I should charge expense in multiple years. I should expense of this expense in multiple years. Okay. And according to its revenue generation. So here, let's assume this particular laptop will work for 3 years. And using this laptop, I will generate revenue for 3 years only. So simply, how much expense I should be charging every year? So the answer is very simple. It is 1500 is the total expense. I will use this laptop for 3 years. So $500 in each year. So $500 in this year, $500 this year, and $500 in this year. And now my net profit will be $500 and $500, same in all 3 years. Okay, so now here what happened, we expensed it off in multiple years. This particular process that you distribute your expenses in multiple years, which is applicable for assets. Okay, so assets meaning is, asset is something or some asset which offers economic benefit for multiple years or more than 1 year. So this is our asset, and asset should be expensed off in relation to the revenue generated, and this is known as this expense off. So instead of expense off, we call this as a depreciation. Okay, so asset is depreciated in 3 years like this. Now here, for the same concept, that is expensing of your expenses in multiple years related to a particular asset, we use 3 words. So first is obviously depreciation, second is depletion, and third is amortization. Now understand the difference. So first of all, on concept level or on technical level, there is no difference. The change is in wordings only, or the nomenclature. So depreciation, this particular word, the depreciation means decline in value. So if you consider a particular laptop, so obviously with every year, you will see decline in value of any particular machine or laptop or car or like similar assets, right? So for this reason, the word depreciation is suitable for assets which depreciates or decline in value with passage of time. Very simple. So for example, depreciation can be charged on, say, car, mobile phones, laptop, like this. Okay, so similar type of assets. But we also have assets like building, land. These land and buildings don't decline in value with time, right? So that's why we don't use word depreciation, because the connotation of depreciation or the meaning of depreciation is decline in value. But these assets, the land, building, doesn't decline with value, decline in value with time, right? And for these type of assets, we use the word amortization. Okay, so assets which doesn't decline in value with time. And amortization is also used for intangible assets. Intangible assets means the assets which you cannot touch. That's the simplest definition. So for example, if I say know-how means, say I have one particular recipe of how to make a best biryani in the world. Now you can't touch that. Obviously you can touch the paper on which that recipe is written, but you can't actually touch the recipe. So that recipe is also known as know-how, is intangible asset. Goodwill is intangible asset. Then in case right now if you don't understand the proper meaning or the clear meaning of goodwill, then don't worry about it. So we will discuss goodwill in next reading. Again, the example can be patent, right? So you can touch the prototype, but you can't touch the patent. Patent is just a blueprint of that particular prototype, right? So are just a license authorized to you, like that, the trademark, logos and all. So all these are the intangible assets. So these intangible assets, there is no fixed definition of decline in value for these intangible assets. So how can you say the logo is declining in value with time? Not possible, right? So for these type of assets, we use the word amortization. Okay, now depreciation clear, amortization clear. Now the next is depletion. So depletion is used for specific asset, the assets which relates to say natural resources, coal mines, oil refineries, or like that. Okay, so generally in, say, coal mine, let's take the example of coal mine or iron ore mine or so on. So these mines, as you mine all the coals or natural resources from these mines. So the resources deplete with time, right? So that's why the word depletion. Okay, so depletion will be used for assets related to natural resources. Okay, so simple, only the words are different. More or less the treatment in accounting is same, so you will just change your words, that's it. Okay, now next we have methods of depreciation. So first method of depreciation is known as the straight line method. Second is declining balance method, or DBM, and then there is a double decline balance. Okay, so how to depreciate the asset? So for this, first and the simplest method is straight line method. Again, same principles will be applicable for amortization as well. Okay, so if asset is amortizable, then you can use SLM, decline balance method, or DDBM, depending on the scenario or case to case basis, or as per the accounting principles. Now first of all, let's discuss the straight line method. Now first, the basic meaning of straight line method is you will depreciate asset in a simple constant amount. Okay, simple. So here we took the example of laptop, right? So laptop, the cost of laptop, the price of laptop was 1500, and this laptop has a expected life or life of 3 years. So every year we will depreciate this laptop by $500. Very simple. And this is for first year, same is applicable for second year, same is applicable for third year. So $500 and then $500 like this. Fine, very simple. So this amount is constant. We can also calculate rate of depreciation from this. How? So $500 depreciated every year, and total cost of asset is 1500. I guess it should be approximately 33.33% depreciation. Okay, so this is 33.33% on excuse me, on asset value or cost of purchase. Okay, instead of saying asset value, we can say cost of purchase, original cost of purchase or original asset value, 1500. Same will be applicable here and same will be applicable here, like this. That's it. Very simple, easiest to understand. Now there is possibility, right? This particular asset, say for example, at the end of third year, we know the laptop is not going to be completely valueless. There will be some value left in that particular laptop for someone else, but maybe it is not that useful for me as for this particular business. Okay, now see, assume this laptop costs me $5,000. Okay, then residual value of this particular laptop is say $1,000, and useful life of this laptop is say 4 years. Okay, so cost of purchase $5,000, very expensive laptop, premium laptop. Then residual value after 4 years, I will be able to, residual value means, or the salvage value means, I will be able to sell this particular laptop after 4 years for $1,000. So that's my sale value, and life of this laptop is 4 years. Now here, to calculate the depreciation amount, we have to simply take $5,000, that is the cost, minus $1,000, this is salvage value or residual value, RV or SV is the same thing, and then divided by 4 years is the life. And expense or depreciation which should be charged every year to P&L is $1,000. Very simple. And we can also calculate depreciation rate here. So $1,000 divided by cost of purchase. Please remember, cost of purchase. And this is 20%. So we will charge 20% depreciation on cost. On cost. I'm intentionally repeating this again and again, on cost. Why? Because when we get into declining balance method, this 20% rate is charged on something else and not on the cost, like this. Okay, now see what happens when I'm treating or charging 20% depreciation on asset like this. So let's see, this is year 0, that is on this particular time period I'm spending some amount. Okay, so or let's say cost, and I incurred $5,000 depreciation charged, and this is, remember, end. Okay, end of 0th year, so this is just a starting of 0. Okay, and then closing balance of asset. So closing value of asset or net value of asset. The right word is net value of asset. Okay. Now for the 0th year, this is what I'm spending here. Obviously no depreciation because I just purchased this asset, and net asset will be the same. So 5,000. Now we have decided to charge 20% every year. So at the end of the first year, in the balance sheet or the P&L of the first year, cost is same. Obviously, depreciation is $1,000, and what will be the net asset value? So it is 5,000 original cost charged to P&L 1,000, difference is net asset 4,000. Again, for second year, third year and fourth year, we will charge exactly same amount, and at the end of second year the net asset value is 3,000. At the end of third year, net asset value is 2,000. At the end of fourth year, I'll charge the same value of depreciation, and the asset value is 1,000. Okay. Now, at the end of fourth year, we have decided to salvage this particular asset or sell this particular asset, and as per our estimate, we were supposed to sell it for $1,000. Okay, so expected sale value at the time T0 was $1,000, and now see what is the value left in this particular asset, 1,000. So 1,000 worth asset we will sell at the end of fourth year. Simple. So this was the meaning of salvage value. So when we start a depreciation, we have to make sure our salvage value is left at the end of the life of that particular asset. So that's our goal, and that's why we calculate depreciation expense like this. And you can also see clearly like how it's treated in the like year by year. Now next, this is simple, very basic. Now next is the declining balance method. Now here we will use the same example, but there is one particular difference. In declining balance method, we don't charge constant depreciation. In straight line method, our principle was very simple. Okay, so charge straight depreciation. That's why it is called as straight line depreciation. But in declining balance method, we charge depreciation in declining amount. So for initial period, the depreciation is charged, the quantum of depreciation, the amount of depreciation is higher. And as we move into the time, okay, as the years passes, so we will charge lesser and lesser depreciation expense. Now, why one should do that, or why we should do that? So answer is very simple. Generally, it is like very easy to understand, also intuitive, right? Any asset will offer you higher economic benefit in the starting period and its economic benefit will decline with time. If you purchase new car, you will get more fun driving it for the first year and your fun will decline with passage of time. Same is applicable for economic benefits, right? So if you purchase new machineries, so in first year, machineries will be able to produce optimally, okay, so as per the limit or the maximum limit of that machinery. But with passage of time, the efficiency of machinery will decline. As the efficiency declines, automatically it will create problems in producing your goods, right? And that's what we call it as declining economic benefits. So when assets show clear characteristics of declining economic benefits, with time their economic benefits will decline. These machineries won't perform as new, okay? So in that case, we charge or we use declining balance method. And declining balance method is again very simple. So here, now see, here we will assume 20% DBM, okay? So declining balance rate for depreciation. So we are assuming, please note, I am intentionally using this word, we are assuming, then I will explain how it like affects our clear picture or complete picture. So 20% on, for now, let's cut this, okay, and we will use this for calculation. So for first year, end of first year, we will calculate our depreciation. So depreciation is on 20% of $5,000, which is 1,000. So 1,000 charged to depreciation. Simple. So net asset is 4,000. Now for the next year, 20% is on, please note, now 20% is not on 5,000. 20% is charged on net balance, and that's the difference in declining balance method. So in declining balance method, we charge rate on net asset. On the other hand, in SLM, we charge rate on what? On cost of asset. Like this. So that's the difference, okay? In declining balance method, we charge rate on net asset, and in SLM, we charge rate of depreciation 20% on cost of asset. Now the question is how to calculate this rate perfectly. So to understand this, we need some formula, but first we will see what happens if we directly charge 20% here, okay? 20% on net asset. So 4,000 and just a second. So this is 20% of, sorry, 4,000 multiplied by 20% equal to 800 $800 charged to depreciation. Leftover value is $3,200. Then again 20% on 3,200, and the final value is 3,200. Just a second. 3,200 multiplied by 20% is equal to $640 minus 3,200 is net asset is 2,560 multiplied by 20% is 512 minus 2,560. Okay, 2,560, and the answer is something 2,560 minus 512. This is 2,048, like this. Okay, now see the problem. What was our expectation? The expectation was residual value at the end of fourth year should be $1,000, because this is what we are expecting the sale value should be or will be at the end of fourth year, right? So $1,000 should be the residual value, but the problem here is it is 2048. What is the reason behind this? So reason is not a declining balance method. So reason is we used or assumed this particular 20% rate. Okay, so ideally we should calculate this rate using a proper methodology, and I will show you what is the methodology here. But we will begin or discuss the methodology of calculation of DBM, the depreciation declining balance method rate. See here what's happening. This depreciation's expense is declining, and that's why it is known as a declining balance method. If you calculate proper rate, then for the first period the depreciation will be higher, and for the last period the depreciation will be lower. Now, how to calculate declining balance method rate for depreciation? So formula is very simple. This is 1 minus root salvage value divided by cost to the power number of years. Simple. This is the formula. So 1 minus number of years, life of asset 4 years, salvage value $1,000 divided by $5,000 is cost of purchase. So let's do the calculation. So 1 divided by 5, then y to the power x bracket open, 1 divided by 4 bracket close is equal to, then minus 1 is equal to, so this is 33.1259%. Just let me check the calculation. Yeah, I don't have calculation for this. Just a second. 1000 divided by 5000, okay, so 0.20, so 0.25, so 0.20 y to the power 0.25, 66 minus 1 is 33 point. Okay, so that's fine. The answer is correct only. 33.12. 33.12%. Okay, now see here. If we charge 33.12% or simply 33% for simplifying, or to simplify our discussion, so 33% on 5,000, then see what happens. For the initial period, $5,000 multiplied by 33%, the expense is 1650. Now if you recall the previous method, the straight line method, in that we used $1,000, we depreciated $1,000. Instead, in declining balance method, we are using $1650, right? Or sorry, we are depreciating with the $1650. Now if you decline the asset balance or depreciate the asset by 1650, so 1650 minus 5,000, so the answer is 3350. Now again 33% on 3350, and you have to do all the remaining calculations. Here leftover will be $1,000, and this is homework for you. Okay, so I know the calculation, like this will be approximately 1,000. Again, this will match your original problem, like the residual value of asset at the end of fourth year. This was our expectation, like it should be $1,000, and you will get the answer of $1,000. Now this is the declining balance method. Now this is the formula. Remember this formula, must remember this formula. Even if it is not given in your book, you should mug up this formula. Okay, in some notes it is not provided. Now next, double decline balance. Double decline balance. In double decline, this is the simplest method. So calculate declining balance rate. So in our case, it was 33%. In double decline, we will use exactly same rate multiplied by 2. Whatever is the answer, it is the 66%. So we will depreciate asset with 66%. So double decline is used when our expectation is asset declines heavily with time. Okay, so in initial period it offers extensive benefits, but with passage of time it starts to decline heavily and offers very lesser and lesser benefits, and in that particular case we should use double decline balance. Now, so that's a concept is very important. Just you should know what is the meaning of double decline and how it's calculated. So declining balance method multiplied by 2, double decline rate. Okay, so this 66% is double decline. The rest of the process is same. So you can take the 66% multiplied by net asset value. Net asset value is cost of asset minus depreciation. Fine. Now next, depletion. Depletion is not covered in curriculum properly. So depletion is again simply applicable for natural resources, and excuse me, and we use depletion rate according to the results given by the experts. Okay, so depletion rate is based on experts rate, and we don't generally, as an accountant or the chief finance officer, we don't calculate that particular rate. So if the information is given to you, then you can definitely calculate it, but otherwise you don't need to. Anyway, you will get that information. For exam purpose, don't bother about depletion. Everything is same, just as a concept, don't bother about it. Then comes the amortization. Now, as we know, amortization is applicable for majorly intangible asset which you cannot touch or feel. Okay, so you can understand it, you can see it. Okay, so for example, patent, trademark, patents, trademark, know-how. Okay, so know-hows and goodwill. Goodwill in simpler terms, in case you don't know what is the meaning of goodwill, for those I'm saying, goodwill is, say, brand value. Okay, so people trust in that particular brand. Okay, so this is again the simplest definition. It is, goodwill necessarily does not mean the brand value itself. There are two types of goodwill. The first is self-generated goodwill, or second is the acquired goodwill. So in what happens when, say, I'm acquiring one particular company, the net worth of that company is, say, $1 million. Okay, and I'm paying 1.2 million for that particular company or for that particular organization. Now here, that 0.12 extra which I'm paying for that particular company is maybe my own reasons. Okay, I think like that particular company, acquiring that particular company will offer me higher benefits. My logistical problems might be solved, my marketing problems might be solved. So all these reasons are there, and I'm paying 0.2 extra. So obviously this 0.2 extra is not for the brand value, it is for the synergy which I'm getting after acquiring that company. And that's why the goodwill is not necessarily the brand value, but mainly to understand the broad concept, we can say at this particular point, we can say consider it as brand value for now, but later on period in next reading, when we will discuss the goodwill in detail, I will give you the proper information, proper meaning of goodwill, how goodwill is calculated, how the acquired goodwill is calculated, or every discussion is covered on the goodwill. Okay, so in short, now see here. So these type of assets are there. So patent, trademark, and know-hows. Okay. If the assets have limited life, so say I acquired patent for 5 years for $1 million. Okay. So I will expense it off or amortize this particular patent in 4 years. So 0.25 million every year multiplied by 4 is equal to 1 million. Simple. Okay, so 0.25 million every year. So when there is a limited life or fixed life for particular intangible asset or patent or trademark like that, then we will use this particular method, the straight line method. Now second, there is a possibility that infinite life, the life of the asset is infinite. So general rule is you can expense it off in, say, 10 years. Again, this will be based on assumption. For some intangible assets, clear guidelines are given. So for some intangible assets, there are no guidelines. So for this, 10 years is a standard. You can amortize particular asset or expense it off this particular asset in 10 years. Now there is problem with goodwill. Okay. Goodwill is very disputable type of asset. Okay, so in generally we don't amortize goodwill generally. Again, the specific discussion we will discuss it in there are next topics where we will discuss tax related problems and which relates to goodwill or balance sheet problems of goodwill and so on. So in that part we will discuss goodwill properly, but generally you're not allowed, as a company you're not allowed to amortize goodwill in your balance sheet. Okay, so reasonings are there why we don't, or why we are not allowed to do it, but not allowed. But you should revalue, not allowed to amortize. Okay, but you should revalue goodwill every year, or at least once in a year. This is what we say. So what is this, like, what is the meaning of this? You don't decide in the beginning, you don't decide the fixed rate of amortization of goodwill. So if the goodwill is constant, if the value of goodwill is constant, keep it like that. Don't touch it, don't amortize it, don't expense it off. But every year, revalue it. Say I acquired one particular business and I paid $20 million extra to acquire that, and this is my goodwill for now. We will assume that $20 million is my goodwill for acquiring that particular setup or business. Now here at the end of say first year or second year, so first year I checked the value, I did the valuation of goodwill and I found it is still 20 million. At the end of second year I found it is still 20 million. But at the end of say third year I found there is decline in goodwill's value. Now value is 15 million. So now in this case, in third year, you are allowed to amortize $5 million in P&L. Okay, so only $5 million can be amortized, but further apart from $5 million, you are not allowed to do anything. If say it is possible, okay, sometimes goodwill declines, then goodwill might again gain value and all. So if it gains value, then again there is different treatment, which we will discuss in later parts. Okay, so that's all about like the depreciation, amortization, depletion, and amortization of specifically goodwill and so on. One more thing, from the income, the treatment of goodwill from the income tax standpoint is different compared to the company laws. Okay, so company laws which governs the companies, and income tax which governs obviously the income tax laws. So treatments of all the expenses generally are different, and specifically for goodwill it is completely different in India. Now irrespective of what happens, if you are from India, just remember this, in India irrespective of what happens, you are not allowed to treat goodwill as an expense. Even if it becomes zero, you are not allowed to charge goodwill in income tax statements, income tax balance sheet, income tax P&L. This you need to remember for your general knowledge purpose, not testable in your exam, because CFA is not Indian exam, right? So look, that's all about the depreciation. See you in the next video. If you have any queries, you can comment on this video. I will help you with these queries. Okay, bye, take care. See you in the next video.